Hi, my name is Ashlyn Talcott. I'm a recent graduate from Westminster College. I graduated with 2 Bachelor of Science degrees in Business Management and Finance. During my time at Westminster, I served as Delta Mu Delta President of the college's DMD chapter, and I got pretty involved on campus. I joined Griffin Quest Leadership Program. I took part in the Alumni Mentoring Program, and I was able to represent the Gore School of Business by being the chosen student speaker at the 2021 commencement ceremony. I recently obtained a full-time position with a startup luxury skincare company, Deaun Beauty Co., as their creative director. Looking forward, I plan to attend Westminster's MBA program and eventually start my own business.
Hi, my name is Deaun Saxby. I'm a current senior at Westminster College majoring in finance. I am also the vice president of the ASW Student Government. Along with that, I am the president of our Black Student Union here at Westminster College and was accepted into a leadership program called Griffin Quest sophomore year. I recently accepted a job offer with Utah Council for Citizen Diplomacy as their Events and Outreach Director, where I work alongside members of Congress and Utah representatives. Early this year, I was one of 21 accepted into a highly competitive year-long program called Emerging Leaders with the Global Ties US. I also had an amazing opportunity to be featured in the Emerging Leaders Spotlight, Utah Division of Multicultural Affairs blog. In the future, I hope to obtain my MBA with Westminster College and open up a wedding and event planning company.
Hi, my name is Ian Rose. I'm a senior currently pursuing a double major in marketing and finance at Westminster College. I'm a strategic business development intern at the SaaS company Tiled, where I developed the company's first sales-specific onboarding playbook. Outside of that, I play for Westminster's men's soccer team and have the pleasure of representing them on the Student Athlete Advisory Committee on campus. I play semi-professional soccer for the Park City Red Wolves as well. And upon graduation, I plan to pursue a full-time career at Tiled as either a business development rep or as an account executive.
Throughout this video, we will be discussing whether or not we believe that the current price level of the asset class, residential real estate, represents an asset bubble, the effect of inflation, or the asset having come into its own. As a brief introduction, we will break down the following phenomena to provide a little more context.
First, a bubble market is an economic cycle that is characterized by the rapid escalation of market value, especially in the price of assets. This fast inflation is followed by a quick decrease in value, or a contraction, that is sometimes referred to as crash or bubble burst. Asset bubble is a situation in which asset prices appear to be based on an implausible or inconsistent view about the future.
Next up, we have an inflation market. Inflation is the steady increase in the price of goods and services over time. It devalues units of currency, like the US dollar, resulting in consequences like higher costs of living. The inflation rate per year ranges on average from about 1 to 4%.
Third, when an asset is believed to be coming into its own, the asset is adhering to the principles of supply and demand. In this stage, you see periods of sustained growth without any outside anomalies. In other words, it means an asset is operating as a normally functioning market.
After giving a brief foundation of each of the following situations, our team will now state our concluding position. We believe that the current price levels of the asset class, residential real estate, represents an asset coming into its own, which means we do not believe the price levels are a byproduct of inflation or bubble. We will now offer support for our conclusion.
It is no wonder that many are skeptical that there is a bubble in the housing market. Typically, rapid increases in asset prices can be an indicator of a bubble. And when real estate prices have been rising in the double digits year over year, the worry of a bubble burst makes sense. In Salt Lake City alone, home values and prices have gone up about 16.4% over the last 12 months. However, once we dive into the fundamentals, we find that the actual underlying data shows justification for the housing market's rise. From an economic standpoint, we have seen an environment that has shifted the market scales towards a seller's market, but still a market with justifiable foundations and solid fundamentals, indicating the lack of a bubble market.
As Taylor Marr, lead economist for real estate website Redfin explains, a real estate bubble occurs when home prices escalate beyond what can be explained by the fundamentals, like mortgage rates, population growth, or household income growth, thus eluding the price levels to be a result of a normally functioning market.
We would like to highlight the three main factors that are driving the increasing prices of the current housing market: inventory, demand, and interest rate.
Inventory has been a huge factor in the increasing asset prices. In fact, it is the lack of inventory that has been the greatest driving force. There are just not enough properties on the market right now for sale. Leading statistics tell us that the number of houses for sale is at an all-time low. At the current pace, we are at just a 2-month supply with homes selling at record speed, with an average of only 20 days after being listed on the market.
Let's take a look at this graph. This graph shows us the monthly house supply in the United States by year. We can see that since the peak in 2008, there's been a drastic decrease all the way up until the current year, 2021. In fact, the monthly supply of houses hasn't been this low since the early 2000s.
One key reason for this is when the coronavirus pandemic hit the U.S., the whole country went on lockdown. Almost every industry was halted, including construction. So as we begin to come out of this year-long pandemic, the supply of new housing is very limited.
We know from basic economic principles that when supply decreases yet demand stays relatively constant, prices will increase. Furthermore, when supply decreases yet demand increases, prices tend to go crazy, which is exactly what we're seeing right now.
So why exactly is demand increasing? And is it at a sustainable rate? Well, the second answer is likely yes. The slope of demand growth is sustainable. In fact, it is still less than what it was in the years between 1990 and 2006. Furthermore, the reason the housing demand is sharply increasing comes from the emergence of a few demographic groups that are outside of the norm.
We now have the usual new home buyers, such as recent college graduates, empty nesters, newlyweds, etc., competing for the limited supply of housing with the new groups of home buyers.
One of the newer groups of potential homebuyers are former college students. The student loan industry saw a huge spike in the loan issuance rates about 10 years ago. And with most student loans carrying a 10-year payment period, those former college students now have some financial freedom. And what better way to celebrate their newfound freedom than buying a house? Let's look at a quick graph to show this peak.
This graph shows us the number of student loan borrowers in millions by year. As Ian mentioned, we can see a large peak in the year 2010 for student loans. About 10 years forward, in the year 2021, these former students have likely just finished paying off their loans with the traditional 10-year payment plan. Another example of an on-the-rise demographic includes those that have recently recovered from the 2008 financial crisis. Many investors' credit was destroyed due to the last housing crash. After credit devastation, it typically takes about 10 years for the individual to be able to qualify for a reasonable interest rate on a mortgage. We are just beyond that 10-year target. Since those people can now get a reasonable mortgage rate, it looks like it's time to buy.
Lastly, throughout the pandemic, we are seeing more and more white-collared workers working from home. With this new remote working environment, many individuals are now wanting to upgrade or invest in their at-home office spaces, again, increasing demand.
The Washington Post also pointed out that there has been increased demand from buyers who delayed purchasing homes because of the pandemic. From existing homeowners who need larger spaces to accommodate parents working from home and children attending school virtually, to condo owners who are seeking to escape multifamily buildings for single-family houses to mitigate exposure to the virus.
Then, there are the other externalizing factors that might not get the headlines but are also moving the needle, like technology, including online listing platforms, digital mortgage approvals, and virtual closings, which has fast-forwarded the speed at which homes are marketed and sold, particularly during the recent pandemic, in turn artificially hastening the pace at which demand is outstripping the supply.
The last of the fundamentals we will touch on is interest rates, which is another large factor causing the demand to increase.
When interest rates decline, it makes mortgages less expensive and houses more affordable. Obviously, this is attractive to buyers, and to give a little perspective, mortgage interest rates have stayed at record lows through 3 successive presidential administrations, as the Dow Jones, NASDAQ, and S&P 500 have nearly tripled during that same period. This increased affordability has 2 effects. 1, it increases demand. More people want to take advantage of cheap money. And 2, it pushes up housing prices all on its own. People can and will pay more for that same house. Bidding wars.
After this in-depth analysis of what differentiates this asset from a typical bubble market and an answer as to why we believe the current price levels of our discussed asset does not follow along with those bubblish trends, we will quickly talk about the effects of inflation on the market. Let's take a look at the graph.
This graph is pretty self-explanatory, but what we're looking at is the inflation rates in the US over the time period of about 2005 to 2021. We've seen a range of about 3% back then to now 4.2%.
So, although it's fair to say that the housing prices have increased as a product of organic inflationary levels, we cannot say that the price increases have been a product of inflation alone.
Throughout this video, we have explained why we believe that residential real estate is simply an asset coming into its own and functioning normally, rather than being a bubble market or solely the result of inflationary patterns. Due to the coronavirus pandemic, the lack of new construction meant an unusually low housing supply for buyers entering the market.
On top of that, as we mentioned, there's a new subset of home buyers entering the market as we move out of this pandemic. This unprecedented bump in demand, paired with the low supply levels, have rightfully caused the housing prices to surge over the past year.
Because we can explain this rise in the housing prices and values by looking at the fundamentals of economics, we believe this doesn't fall under a bubble market. Furthermore, although inflation has played a role, it is not the sole reason that we're seeing these rising prices and increased home values.
Thank you for watching our presentation. Have a great summer.
Bye!
Woo!